Yeah, I worry a lot these times more than I mean, as an analyst, as a PM, we're paid to be worriers, and that's one thing that we can't emphasize enough. It's hard to manage return. I think what we focus on is managing risk and expecting, that return associated with that risk to pay off. So there's no shortage of things to worry about on the risk front. What I would say is that, the market is being, and I'm not calling for weakness necessarily, but when we look at the market on a top-down basis, we're struggling to get a lot of upside from here. You could have some, but to the extent that oil prices stay higher and begin to damage the economy, I mean, everyone thinks, oh, it'll be a short war and all of a sudden things will roll off. But we've now affected, natural gas, oil, future production, costs are going up, shipping insurance. The more that this war goes on, the more that ultimately that will undermine the positive tailwinds that we had coming into this year with the one big beautiful bill, and with better growth and really, I would say economies around the world having very aggressive, liquidity positions. So what I mean by that is, all else equal, central banks probably with this inflation target would have been, maybe taking up interest rates a little bit, as Australia has recently done, because inflation is still missing targets, but they really haven't. And at the same time, too, fiscal policy has been really, really loose. So I think there is a very strong tailwind. It's just if this war goes into June, let's say, I would be really worried about the back half of the year, coming off that really resilient growth trend, while inflation is certainly going up from here. So that puts policymakers in a bit of a bind.
Yeah.
By rights, we see stagflation, and stagflation is not a great environment, certainly for nominal bonds, but also for a number of areas in the stock market as well. So I guess my biggest worry is that the longer this war drags on, the more that's going to damage the second half of the year. And you may see that as early as this quarter, as I mentioned, with some of the outlooks that companies will give in what we expect to be an otherwise, tremendous earnings season. So that's my biggest worry. I think, and part of that is associated with the fact that we're at all-time highs now. Oil is up 25%. Other input costs are up a lot. To me, that says that margins, probably need a bit of a trajectory. Now, the good reset lower. Now, the good news is we're at all-time highs. So we have been super efficient, and corporates have had great margins. But if we get a quick resolution to this war, I think the one thing that I'm pretty positive about is we've seen this rotation, right? So other markets have done some heavy lifting. The S&P has actually come down a little bit. And some parts of the market, like technology, which I think will be a long-term, great sector, and you're able to buy some of these, some of these stocks, especially with the software sell-off, at really reduced multiples, even like COVID multiples. So the rotation that we've seen in the market has actually enhanced some of the breadth in the overall market, which is really necessary, I would say, for an extension in this bull market. So that's kind of what I'm hopeful about. If that continues, I think, energy companies, utilities, it's not just all about tech or consumer discretionary. I think that's actually a market positive from a breadth perspective. So I'd be hopeful that really does continue.